Hello everyone, this is Professor Choi. One of the reasons why I'm back today is because something just happened in the stock market in the last few days, and my students have been calling me and sending me messages to basically ask me what is going on and how do we explain this behavior. So today we're going to give you a quick video on what exactly is a short squeeze and how that in the stock market can create prices that can go up very quickly. Alright, first thing we need to study, and again remember my approach is usually to kind of teach you about it. So the first thing we need to talk about is what exactly is a short. Because most people don't really understand that you can actually make money when stocks are going up, but you can also make money when stocks are going down. So a short is basically when you're trying to make money betting that a particular stock is going down. Let's come up with an example. So let's say that we have a stock that right now is at $10. And you think that this stock is going to go down to say $8. So you think it's going to go down to $8. Now one of the things that you could do if you think a stock is going down is you could short it. Now shorting, what it basically is you're going to go ahead and borrow this stock from your broker. So you're going to borrow this stock from your broker. Say you're going to borrow 100 stock. Okay? Now what you're going to do is you're going to sell these 100 stock at $10 right now. So you're going to borrow and then you sell it in the market at $10. So in hand you collected $1,000. Okay? Now let's assume that you are correct, so you see how the short makes you money. Now let's assume that the stock in fact goes down to $8. Now how do you make money with this? Well, the reason you make money with this is because now at $8 you take your 1,000, you're going to buy this stock. So you take your 1,000 and you're going to buy 100 stock at now $8. And what just happened? Well, you just made $2 a stock, because when you buy 100 stock at $8, you can then take this 100 stock that you borrow and you give it back to your broker, but you then keep the difference between those two. So this one's going to cost you 800. This one was plus 1,000 for you, so you keep a profit of 200 in this transaction. Hey, that's a short right there. That's how it works. Now, most people normally don't short, but there are plenty of companies out there that love to short. A lot of them are what they call hedge funds. Okay? Now, these companies basically are personally managed by a few number of people usually, fairly wealthy, and they have plenty of capital. So a lot of these people can put massive shorts on particular stocks in the market, usually holding their price down for quite a lot because, of course, again, every time you short, you sell the stock. So they are the ones who are basically shorting and selling and making the stock go down. Now, to be honest, most people in Wall Street don't like shorts. In other words, they don't really, they don't like the people who normally short. And the biggest reason for that, of course, is because you're betting against the company. So, what happened in January 26, 2021? Well, in a very basic way, lots of people got together and decided that they were going to stick it to the man by basically running their own trade and making particular stocks go up. I got to tell you that I kind of feel for these people because I love AMC as a company and I really want their success. I watch movies in AMC, is my theater. I also go to GameStop all the time, and I grew up with it, trading my games and basically buying stuff in them. So I feel it. I mean, I really feel for the people that are trying to prop up these stocks, and they're doing it in, let's call it, sort of democratic way, you know. So the little guy is the one propping up these companies. Now, let's explain how all of a sudden these companies can massively skyrocket in price, and that is what we call a short squeeze. Alright, so somewhere around January 25th, if you would have seen the stock of AMC, it was sitting around $2.45 or so. Okay, and then By the time it hit its peak, somewhere around January 26, that stock had run up all the way to around $20 or so in one day, making some people a lot of money. All right, now, why did this happen? You know, how can a stock go from 245 to 20 so quickly? The answer basically is because there were a lot of hedge funds out there who were massively short on this stock. In other words, there were a lot of these people who already put plenty of this stock on the market. And then now all of a sudden, there was a group or a bunch of groups on Reddit that decided that they were going to start pumping this stock. This is what we call a pump. A pump basically is when you tell people to buy and basically buy. And then of course when a lot of people buy the same thing at the same time, it makes the price of the stock go up. So that created a movement, and I don't know exactly how much of the movement because I didn't follow it every day, but basically created a movement up fast enough to around $4 or so, or even higher, that then trigger a lot of these hedge funds that were massively short to buy the stock very quickly. So the stock, after it was pumped by these Reddit groups, then had to be squeezed even faster upwards by these hedge funds that were trying to basically cover their shorts. In other words, they were massively short, and I want you to understand that if you're wrong in the opposite direction in a short, you're going to lose a lot of money very fast. Okay? So let's talk about why do you lose money when you're wrong on a short. Okay? Back to the same example. Imagine that you have the $10 stock and you hold one and you bought 100 of them. So basically you got $1,000 in your pocket. But instead of going down to $8, the stock decides to go up to 20. Okay? Let's think about what happens to you. Well, what basically happened to you is that now you're going to have to give the stock back to your broker. And in order for you to give it back to your broker, you're going to have to buy, because you sold at 10. So you sold 100 stock at 10, but now you're going to have to buy to give it back to your broker 100 stock at 20, which basically means that you just lost $1,000 because you're going to have to buy back your stock for $2,000. And when you sold it from your broker, you only make $1,000. So now you're minus $1,000. Now, of course, when we say that a company is massively short, we're not talking about 100 stock. So you go ahead and start adding zeros to that and understand how quickly these people need to react. And welcome to a short squeeze. Now, of course, the biggest thing you need to understand here, by the way, is that prices never stay up forever. So this is the reason why in the stock market they call it a short squeeze, not a short forever or a change in direction or a secular movement, okay? This is going to happen for a very short time, and this is one of the ways in which it can happen. Somebody is massively short, you get a pump from somebody, in this case again was a Reddit group with a lot of people that were following it, and then now all of a sudden short squeezes in, prices move up very quickly. But I can bet you in the next few weeks and next few months, prices will settle back down. Now, I want everybody who's listening to me to be very, very careful. This is not the way to invest money for the future. If you want to bet your money, what you're doing here is very similar to putting your money in a casino. So if you're going to be doing this, then make sure that you don't put a lot of money that you need. Okay? So if you're going to play, only play with money that you're willing to completely lose, because this kind of stuff never ends well. And if you don't believe me, just keep looking for history on this kind of stuff. Alright? So anyway, thank you for joining me today, and I hope you learned a little bit about what a short squeeze is. This is Professor Choi, and hopefully you'll be back. Have a good one.